right. New England Seafood Company is currently running their operations with the sole focus on harvesting and processing seafood from both the Atlantic Ocean and the Gulf of Mexico. However, recent events have been pushing their sales down, and they are currently considering entering the freshwater catfish market. This move would require 2 stages. Stage 1 would involve the construction of multiple catfish ponds as well as minimal processing facilities. And stage 2, beginning 5 years after stage 1, would involve building a much larger pond and processing facility, implementing new research and development, and overall expanding the project into a permanent division of New England Seafood Company. New England Seafood stages of the project have been analyzed for their financial stability, and we feel as though we're confident in advising them in their decisions.
To start the analysis to see if New England Seafood Company should uptake this project, we needed to find the weighted average cost of capital. For this calculation, we found the weighted average cost of capital to be 10%, but depending on the risk, we could add 3 to make it 13%, or we could take away 3 to make it 7%. The next step was land acquisition. New England Seafood Company had 2 choices. Their first choice were they could just purchase land for $1 million now and use that to start manufacturing. The second choice was that the Gulf Shrimp Company had a plot of land that they could use, but an issue occurred where they would need to replace that land for the Gulf Shrimp Company. They were given a choice to purchase an option for $100,000 now and then pay $1.3 million in 5 years. To determine which choice we should take, we calculated the present value of the land for the current option and found it to be $807,000. We've determined that we should use the Gulf Shrimp Company's land and then purchase the option.
When looking at the other cash flows associated with stage 1, we were able to find out that there was research and development cash flows. For the year 2017 through 2021, there would be $200,000 of research and development cash flows for each year. This number was calculated by using the $2.5 million that was capitalized and amortized over the 5-year period. This left us with $500,000 per year, and from there we took the 40% tax rate and resulted in $200,000 each year. It was also concluded that there should be a research and development cash flow included in 2013 in the amount of $1 million due to the opportunity cost of having tax savings. Lastly, we computed how salvage values were taxed and determined that it was book value minus market value minus accumulated depreciation times the tax rate.
So next we filled out a statement of cash flows for stage 1. As they just said, we determined that the land for this project will cost us $1 million and that our R&D expenses will be $200,000 each year from 2017 to 2021. Next, we had to find out the amount of working capital we invest every year. The $6 million in 2016 was already given in the case. The case also said that we invested 25% of the increase in next year's sales each year. To find out how much we invested each year starting in 2017, we subtracted the sales from the current year. So in this case, $20 million from the sales of the following year or $22 million, which is $2 million. When we multiply that by 25%, we got our $500,000 investment in working capital for 2017. We did the same for the next 3 years as well. Now, because our goal was to simply find the cash flows of stage 1, to find the working capital in 2021, we added together all of the previous year's working capital expenditures because the case states that we will get these costs back if we choose not to continue on to stage 2. The total capital is simply the sum of the columns so far, and the operating values were all given. So next, the case states that the land had a salvage value of $2 million at the end of stage 1. To find the land salvage value tax, we multiplied the proceeds from the sale of land by the 40% tax rate because we will have to pay the taxes on the gain from the sale, which equates to $600,000. The case also tells us that the salvage value of the building will be $3 million. We paid $4 million for it, and the building will have an accumulated depreciation of $640,000 by 2021. So to find the salvage value tax, we take the $4 million that we paid for the building, minus the $3 million salvage value, minus the $640,000 of accumulated depreciation, and multiply that by our 40% tax rate. This is a positive number because we are taking a loss in the building, so we will have a tax shield. We did the same with equipment. The case estimates that the salvage value of the equipment is $500,000. So to find the salvage value tax, we took the cost minus the salvage value minus accumulated depreciation and multiplied that number by the 40% tax rate to find our shield for equipment. Our net cash flows for each column are the sum of the total capital and total operating cash flows. For 2021, though, we also included the salvage values and the tax implications of the sales of our land, buildings, and equipment.
Assuming that stage one was judged to be of average risk, we calculated standalone net present value, its internal rate of return, its modified internal rate of return, and its payback. First, we just determined its net present value to be negative 2.62 million. This was calculated by using the 10% as a discount rate and using their net cash flows for the years 2014 to 2021, and then adding the net cash flows for 2013. For internal rate of return, we simply took the cash flows from 2014 and 2021 and calculated it to be 5.97%. Next, we calculated the modified internal rate of return and used the cash flows from 2014 to 2022 and using 10% and calculated it to be 7.2%. Finally, we had the payback period and was calculated by taking 7 plus the sum of all the cash flows and divided it by the final year of the project's cash flows. By doing this, we got the number to be 7.61, which essentially means that it would take 7.61 years for this project to pay off its initial investment.
As stage 2 of the expansion project is implemented, more costs are undertaken as the project grows. You can see there are different returns for 70% probability of high demand and the 30% probability of low demand. Once these scenarios were known, expected demand could be calculated based on the probability of these occurrences of these demand scenarios. Based on the scenarios provided, we can calculate stage 2's standalone NPV by discounting expected return after 2019 at 10% and netting it against our stage 2 initial investment of $12.5 million, giving us an expected NPV of $8.4 million. We also found internal rate of return for stage 2 by imputing cash flows from 2019 to 2025 into the IRR formula within Excel. And modified IRR was also calculated through Excel using the same year's cash flows, but with a 10% reinvestment rate. Using these formulas, we are able to find that stage 2's standalone IRR is 18.85% with a modified IRR of 16.65%. As well as this, we calculated payback by using the number of periods, not including 0, minus 1, minus the sum of cash flows of 2019 through year 2024. Over cash flows of year 2025, giving us a final value of 4.2 years. These values were all standalone, so we also calculated the NPV at today's values by further discounting the NPV at t equals 6 periods at 10% to reflect a correct present value of $4.75 million.
Next, we were tasked with creating a decision tree for the various demand scenarios associated with stage 1. Before we undertook this task, we were informed that there was an 80% chance of stage 1 meeting expectations. Knowing that, we multiplied 80% by the probabilities of each scenario, which was 70% for high demand and 30% for low demand, and then plus the 20% of stopping after stage 1. We multiplied the NPVs of each scenario that we had found earlier by the new determined probabilities and summed the products to find our expected NPV, which was 1.17 million. To analyze the risk of this project, we plugged the NPV values into a standard deviation calculation to find the standard deviation of 1.81 million. Dividing that by our expected NPV gave us our coefficient of variation, which was 1.54. The coefficient of variation being 1.54 means that it was greater than 1.5, therefore making this a high-risk project. Since this was a high-risk project, we needed to add 3% to our required rate of return, making it 13%. We calculated the NPV values for each scenario as we did before, except this time we used 13% as a discount rate instead of 10%. Multiplying the risk-adjusted NPV values by the joint probability and summing the products gave us a new risk-adjusted expected NPV value of negative 2.07 million.
Though the MPVs we calculated in the early stages of our case were often positive, we recommend that New England Seafood Company does not go forward with this project. The coefficient variation for this project is 1.54, which is considered high risk for the return it may provide. Due to this, our calculations needed to be adjusted, as explained in questions 7 and 8. Once volatility is accounted for the expected net present value, it turns negative and a positive return is not expected. Overall, with the risk and timeline of the project properly accounted for, we believe that the risk will not return reward and the project should not be done.
Using the coefficient of variation is not a bad way to measure risk, but it's not the most preferred way. Because it is unlikely the company will only have this project, we need to look at the risks the company takes on for the whole portfolio. New England Seafood Company can diversify its ways on unsystematic risk by choosing between different projects. This means that we should only need to factor in the unsystematic risk that cannot be diversified away. To measure this, the company should use beta. Some of the things that executives brought up to us was one of the things we needed to change was variable cost. If variable cost was increased from 70% or 75% from the 60% from before, this would also change our net income, our taxes, our net operating income, taxes, net income, and ultimately our net cash flow. At 70%, our phase 1 net present value was negative 6.72 million. And phase 2 expected net present value was 2.92 million. At 75%, this lowered even more to 8.77 million, and expected net present value lowered to 4.97 million. As variable costs rise, net present value of the project lowers, so we would still recommend to reject the project. Other changes they thought that we may need was assuming the salvage value was, instead of 37.5 million, we lowered it to 30 million. And the probability of high-low demand would be 60 and 40 versus 70 and 30. This lowers our net present value of high demand and our probability of high demand project after phase 1 to 48%. Net present value of the low demand project stays the same, but probability is increased to 32%. Our overall net present value using these new criteria is negative 582,000. Therefore, we would still reject this project. Are there any questions?